Hey, good morning, everyone. Marty Mazzori here with your end of week update. It is Friday, the 11th of July, 2025, about 2 hours and 20 minutes before the market close. I'm going to do the same thing I did the last couple of times, and that is I want to get through the market stuff and the charts very quickly, right off the bat, and then I'm going to share with you what I think is the more meaningful commentary that we should be considering right here. So to begin with, the market this morning, just to kind of get a feel for breadth again, kind of like the day before yesterday when it was about the same time in the morning and the market was up a little bit. Right now it's down a little bit, but breadth is very interesting. For example, and you can see my breadth table here, the NASDAQ Composite Index, as you can see, has over 3,000 members to it or positions in it. And as we speak, 2,158 of them are down, 766 are up. And believe it or not, the NASDAQ Composite is actually up 6 basis points. It's not much, 0.06%. But as you can see, 70% of the stocks in the average are actually bleeding this morning. So very, very concentrated market. The S&P is down about 1/3%, but 405 of the S&P 503 stocks are in the red. The Dow is down more so, about twice that much. Dow is down 2/3 of a point with 70% of the stocks. That makes sense. Breadth is bad, market's down, so forth. It's the NASDAQ that kind of jumps out at us this morning. As for the core portfolio or core allocation, it's kind of tracking the S&P. It's down 1/3% as well. The equal weight index, the S&P equal weight, which isn't concentrated, obviously, by definition, is down 0.68%. So it's down about twice what the broader average is down, which the broader average, again, has that concentration in a handful of tech stocks. What's working today for us, for our core, is gold is up 0.86%. Palladium is up 6%. A European energy related company that we own, is up 1.2%. Range Resources, which is a nat gas company, is up 1%. So we have a chunk of positions. Indonesia, which is a recent ad for us, is up almost 2/3% today. Energy stocks are up and so forth. So our very globally diversified portfolio continues at the moment to mitigate enough of the market risk. Certainly has on a year-to-date basis. Okay, so another look at breadth is just looking across sectors. As you can see, healthcare in the U.S. is down over 1% today. Financials down 1%. Materials down 1%. Utilities, so pretty much across the board. The only thing working at the moment on a sector-by-sector basis is energy and consumer discretionary stocks. Tech is flat, pretty much. Okay, so in terms of the charts, there is nothing really to spend a lot of time on. I showed you the weekly and the monthly yesterday, which are concerning. And here we are just moving sideways out of this rising wedge pattern on the S&P daily chart. Still have bearish divergence here on the MACD, back into overbought, just coming off of overbought territory. And I've shown you historically that odds do not favor a sustainable rally from here, given these patterns. Unequivocally could happen, but it would take some news, geopolitical news probably, to make that happen. The NASDAQ 100, virtually the same picture as the S&P. As for the dollar, again, remember right in here I said the dollar looks ripe for a rally. Getting that, breaking out above this very defined downtrend line. Long term, we have a very much weaker dollar thesis. Short term, we think that it's due for a bounce, and we seem to be getting that somewhat right here so far. Bounce today on tariff news, we'll talk about that. Yields really spiking today. And we've, again, broken above this downtrend line on the 10-year Treasury yield. This should be a serious headwind for stocks. It's not huge today in terms of stocks selling off. but yields going up are interesting to me. Now, Bloomberg headlines, remember media has to come up with an excuse, say on the potential inflationary effects of higher tariffs. I would argue, as we talked about, I think on Wednesday, that yes, on an item per item basis, you could argue that tariffs are inflationary. You could argue that they are across the board inflationary at a time when animal spirits are alive, when there's tons of liquidity in the market, and so forth, meaning that people are, instead of pulling back on other items when they pay the higher price for a tariffed item, if they have plenty of confidence and plenty of cash, well, they may just keep buying everything else and allowing for higher inflation. Sentiment has improved a bit of late, certainly market sentiment, but I don't know that that would be the right narrative given all things that the world is contending with right here. I think it's as much about concerns over future treasury auctions, or concerns that the government is running these massive deficits and they're going to have to borrow to fund them, and therefore concerns that the rest of the world is going to be willing to buy them. I mentioned that gold is up notably today, right? Well, higher yields means bonds are down, treasuries are down notably. So all else equal, you would say that the powers that be or investors in general or globally are selling U.S. treasuries today and buying gold. I don't know that that's the relationship necessarily, but you could argue that that makes some sense relative to, international events and sentiment and geopolitics and that sort of thing. You could also argue that there's some bullishness around this new, quote, one big beautiful bill or one big beautiful act at this point, right? In that, there's some accelerated depreciation benefits for companies, and maybe that could be bringing some animal spirits alive and so on. But as I continue to suggest, that if we juice the economy, if you will, at a time when we're not in recession, or it's not obvious that recession is looming. Now, we see some real recessionary signals that I continue to show you that suggest that indeed it may be closer than people think, or that it may indeed make sense that the Fed starts cutting interest rates sometime in the second half of this year. If indeed that's not the case, and if indeed this bill is going to rescue the economy from recession, well, then yields should be higher, right? Then we shouldn't have lower yields. We shouldn't have rising bonds because inflation isn't going anywhere. Inflation's going to probably ramp up further. That's not about tariffs, though. That's about stimulus. That's about fiscal stimulus and fiscal, accommodation for the economy. And then you get somebody like Fed Governor Chris Waller, who really has his eye on Powell's job next year. There's no ifs, ands, or buts about it. Who is normally hawkish on interest rates, literally saying that they should cut the Fed funds rate in July. And of course, he's saying, now this isn't political. Well, we'll see. That's what the appointors definitely want to hear from the potential appointees at this point. I'm saying, be careful what you ask for. It's all about the timing. But Waller, who is out there, who has been a critic of too low interest rates and so forth, is suddenly becoming this, big dove on interest rates. So you can tell there's a little skepticism in my voice. But at the same time, our assessment of the economy isn't all that great. And while I do think a July rate cut is premature, I think I could justify it with the data, some of the data anyway. A September rate cut makes a lot of sense to me if the current trends continue as they are. And that could be bullish for the market, but it would have to be coincident with some real disinflationary forces. And that's not necessarily what's showing up right here. As for gold, again, here we have the dollar rising today, we have yields rising, and we have gold rising at the same time. Now, typically, or very often, the correlations would suggest that if the dollar is up and yields up, gold ought to be down 1% instead of up almost 1%. So this speaks to the uncertainty out there, the fact that maybe there is some rotation out of treasuries into gold, and the fact that correlations lately are not what they used to be, and that tells potentially a different story about how the world works or how the world may be going to work going forward. So, time will tell. I'm hesitant to say that We're in an entirely new regime with regard to a lot of these correlations, but our longer-term thesis says that things are going to be different and things are going to trend a little bit differently. But as we get into the next cycle, I do believe we will see that traditional lower dollar, higher gold relationship. As of right now, those things are changing, on maybe a weekly basis, if you will. Okay, so now to finish up, this one isn't going to be as long as Wednesday's. I want to pull over my morning note, which basically I just cut and pasted Peter Bookvar's morning note and added my own highlights and bolds. So I'm sympathetic with what he had to say this morning. So let me share that with you. So it seems to be a settled debate on the part of some that if there's not consumer price inflation from tariffs, then there is victory with its use. Unfortunately, there is not enough debate on the coming hit to corporate profit margins. Now, those of you who watched Wednesday's video, this will definitely ring true for you if you bought into what I was saying. And that is, there's not enough debate on the coming hit to corporate profit margins for those companies that don't have much pricing power. We touched on that. Companies that make less money usually hire less and invest less. Okay, so that's a headwind for the economy. Remember, I showed you that chart that showed the tariff revenue just absolutely exploding here of late. And we pondered who is ultimately going to pay that bill. To the extent that it hits corporate profit margins, to the extent that they don't pass it on to the customer, well, that is a serious headwind for this market that is discounting record margins as far as the eye can see. He also talks about taxes, right? Again, same vein. Who's paying the bill? The latest post raising the possibility, and that would be the president's post, of a baseline tariff of 15 to 20% instead of 10%. With 3.3 trillion of good imports, a 15% blanket tariff would equal about 500 billion of fresh taxes, and with 20%, 660 billion. So on one end, you could say, hey, this pays for our spending bill, but on the other end, you can say, who's paying it? That would take tax receipts from the corporate tax to about double what was already anticipated, right? So the effective tax rate for corporations could possibly be double or more than that from the current 21%. And then he asks us to remember 2017 when all we did was seemingly rally, all the market did, on every single day on the hopes for the eventual tax cut package. Where are those concerns now with this massive tax hike? He feels like the only one that is worried, and he's living in some parallel universe. Well, he's not the only one, because I worried about the same thing out loud on Wednesday. I hope I'm wrong, but I'm getting more and more nervous that I won't be. Like I said, I very, very much sympathize with his concerns right here. Okay, so he talks about Conagra's latest commentary, the largest frozen food producer in the country, along with snacks business, which includes beef jerky and popcorn. The decline, this is from them, the decline in consumer sentiment during the fourth quarter of fiscal 2025, driven by the cumulative impact of persistent inflation, rising interest rates, and overall economic uncertainty. This decline translated into more cautious spending behaviors. They say a lot here, but I'm going to just jump around in the interest of time. For fiscal 2026, we expect core cost of goods inflation to be approximately 4%. Put into context, this level of inflation in fiscal 26 will bring our 5-year cumulative net inflation to approximately 45%. So clients, we're talking about this often in review meetings. And that is, today, the powers that be are saying, hey, we have no inflation. We've got it under control. The Fed needs to cut. Well, our observation is a lot of people, particularly in the lower half of the income distribution among Americans, is still feeling the effect of, call it a 50% increase on everything or the important things that they buy. Hence the large evidence of delinquencies on auto loans and credit card loans for that cohort. Yes, maybe inflation is going to get back down to 2%, but what about the 50% increase in costs that everybody is still having to endure? That is such a weight on the economy in our estimation. On top of that, the current tariff environment is expected to add approximately 3% of Conagra's cost of goods sold, and that's more than $200 million annually. This brings total inflation for fiscal 26 for them to approximately 7%. So Helen of Troy, they make everything from backpacks, travel gear, hairspray, blow dryers, yada, yada. Their Q1 results were well below expectations. Again, tariff-related disruptions on our shipments was greater than we originally expected in April. Then they go on to give you more detail. And at the end of the day, the tariff effects really aren't yet being felt, or they're not really showing up in the data. So one of their mitigation steps is they're implementing strategic price increases that will take effect near the end of summer. So it's going to be interesting, folks. And obviously, this is not going to be unique to just Helen of Troy. So they go on and on. It's not a desperate picture. It's not, oh no, we're rolling into depression or we're going to have some great recession anytime soon. It's just, no, these are serious headwinds that we need to mitigate, that we need to compensate for. In terms of the market, it's just back to what I said the other day. It's just completely in denial that these potential risks are going to come to the fore and pose something real ugly for the markets. I mentioned the other day that, commentary from friends and employees about, will Trump really, allow these things to happen? And I made the point, and that is the point to make right here, that sure, there's no political party, right or left, that wants the markets to crash, and they'll do whatever they can feasibly do to keep that from happening. The problem is what they can do ultimately would exacerbate the inflation picture, and that by itself is ugly for the market. So in this environment with these valuations, a growing economy that creates faster growing inflation is a serious headwind as well. The big risk for something that we only see every decade or three would be, a notable recession where corporate profits that currently the market has decided are just going to continue to go up and up ad infinitum come down. And so a recession would undoubtedly make that happen. And that would be very problematic for U.S. stocks. But what I'm saying is that the hit to margins could hit profits enough without a recession to be a problem for U.S. equities. So in closing, though, all that said, a couple weeks ago, I did show you a narrative where we could have a good second half of the year, and we need to be very open-minded to that. It's not our base case, but it's not necessarily at all a super low probability event if all of those conditions that I talked about come into play, and they very well may. But what I did say is the biggest risk to that is the president's penchant for tariffs. And if the market were to start believing that he really means it, well, then we have a problem in the pricing action. As I also said recently, that if the market doesn't discount it when it occurs, right, then the administration is going to be emboldened to go tougher on tariffs. But then you get into this cycle where finally the market cracks and then suddenly the tariff rhetoric changes. So in the meantime, the market just doesn't believe that it's going to really happen in a very negative way. That remains to be seen. The news the last 24 hours is, pretty negative. A 35% tariff on Canada, 50% tariffs on Brazil, and these kinds of things. I think at the beginning of the year would have been hugely market rattling. We're talking about an S&P that's only down like 0.25%. And a NASDAQ that's flat right here. So it's certainly not falling apart. So stay tuned. Never a dull moment. Thank you, folks, as always, for watching and listening. And I'll be back very soon. Take care. Have a great weekend. Bye-bye.